Hey everyone, welcome to Retire with Style. I'm Wade and I'm here with my trusty co-host Alex. Say hello to everyone.
Hello, everyone.
All right. And we're continuing our conversation today, Alex, on tax planning. And specifically, we're tying up a few loose strings here, a few different issues that really don't fit together they don't separate into episodes, but a couple minute conversations on a few different topics related to tax planning, including further reasons to front load taxes. We'll talk about tax loss harvesting, deduction bunching, try to say that 5 times fast, and donor advised funds and other charitable tools.
Wait, let's see. Deduction bunching, deduction bunching, deduction bunching. Oh my goodness, I'm on a
Oh, you
roll.
got it.
I
You're
think I could have
nailing
done it. Before the episode, I was specifically, I couldn't say it. But
it.
here we are under
That is a
pressure.
bit of a tongue twister. Deduction bunching.
In Spain, while it rains, on the plane.
But before getting into all that, anything new in your world, Alex?
Yeah, I've had to take some time off from actively playing pickleball because of my wrist, but I've gone down a rabbit hole of pickleball paddles.
Yeah, I believe you've
And you
got
can
an
you
also
can
down the road of eBay, right, for pickleball paddles.
Yeah. That's right. When we were in Dallas, I was waiting on that auction, and my wife is getting on my case, like, yeah, but why are you spending $100 on a paddle that you wouldn't be buying if if you didn't need it anyways? Those kind of things. She doesn't understand.
You
What
got
can
to
I say?
spend money to
Wait,
save money, right?
yeah,
It's a bargain.
exactly, exactly. It's for my it's for my personal development. It's a consumption cost for entertainment. No. But it's amazing how you can go down that rabbit hole. And I was gonna mention there's such a balance between it's effectively a balance between power and control, right? The more power, the less control. The less control, the more power. The more control, the less power. And then you get pickleball paddles out of stock, and then how are you going to personalize it with weights at on the edges? And there's a whole rabbit hole around that topic, and I'm in it now. So that's what's been new, unfortunately. How about
Okay.
you, Wade?
Well, I just had a busy travel week, and yes, we were in San Antonio together. You mentioned Dallas. I think you've lost track of. We were in Dallas at one point too. We were talking about
Yeah,
the pickleball in
we were
San
together
Antonio.
in Dallas, and then a few
The
days
next,
later in
yeah, a few
San
days
Antonio.
later. Yeah, and then after that, I was in Chicago, Omaha, and Newport, Rhode Island. But pretty much
Newport.
finishing up travel for the year at this point.
Yeah, you catching the jazz festival, or is that in the spring or something like that?
No jazz festival this time of year,
All right.
but it was the fall foliage was in full force.
Newport was the first time my wife and I, when we were dating, got in the first like official fight. This is we were in college, and we were like, we
Oh,
take the summer and tour like the New England, since we were already there. And
uh-huh.
in Newport, it was one of those.
So you're
But then
spilling the
we
tea.
then we knew we survived that. We're meant for each other, and the rest is history. But those are my memories of Newport.
Did you do that walk along the cliff with all the mansions and
Oh, the Vanderbilts and stuff like that.
yeah?
Yeah, it's pretty impressive. And then I forgot if we went to Brown around that, since we were around there. I don't know how far Brown is. I think it's right there, right? Brown.
Up in Providence, I think.
It's
Yeah.
not too far
So
from
it's
Newport, I think,
no,
is it?
that's the airport I used. It's a 30-minute drive.
Yeah. And we did that and just walked along the Tennis Hall of Fame. Don't they have that there? That was kind of
Oh,
interesting to
that
see.
I don't know.
Oh my
Yeah,
goodness, you
make
haven't
it a
lived.
pickleball Hall of Fame.
Soon. You haven't lived, Wade, until you've experienced that. But taxes. Here we
Taxes,
are.
right? Well, this was actually our take two, and in take one, you said we're going to be more professional and not have small talk. So we.
But you egged me on right now, and so you literally asked me. So anything new, and if I say no, then
That's right.
it leaves you hanging. So
Okay.
you're gonna hold this against me after I did something to humor you. You're now gonna hold that against me. Thank you, Wade.
But actually, there's a pretty good outtake from that, the unaired take one of the episode. We'll
Yeah, but
have to have some,
there were a couple of bombs dropped on that
yeah,
one. I don't know. We can
couple
that's to
bloopers.
be on the behind the membership wall or something.
Yeah, get on Patreon. But no,
Exactly.
no. Okay, but yeah, let's to give context. So we've had a series of episodes on tax planning. The last few episodes, we were talking about pitfalls. What we're ultimately heading towards, you may want to pay taxes early on strategically to help increase after-tax wealth over the long term. That can involve doing Roth conversions. And we've been talking about pitfalls with that, how it can impact Social Security benefit taxation, Medicare premium surcharges, the stacking of preferential income on long-term, on ordinary income, that sort of thing. But now let's just also consider 3 further reasons why, in spite of all that, you might want to front load your taxes in retirement. And the first of those is just this idea, and this is when you hear people talking about life insurance and that sort of thing, they'll put a lot of emphasis on this idea, whether you find this compelling or not. But to the extent that there may be tax changes in the future, the odds are they're more likely to increase. Tax rates will increase in the future versus decrease. That we may be at a point where historically this is a low level of taxation, and even baked into the current law in 2026, if Congress doesn't take action, the tax rates will reset to their levels from 2017, which are, for the most part, across most of the range of incomes, higher than they are today. And so the idea is, well, if you know you have to pay taxes at some point, you might want to lean towards paying more taxes today at lower rates if you're just worried that in the future tax rates will be higher than they are today.
Now, for folks listening, how do you think about that philosophically? Because someone could say, at the extreme, I may die tomorrow, so what was the point, right? And so ultimately, that's a time value kind of question, or it has echoes of it. How do you approach it personally? Oh yeah, I'm gonna do it today, not even thinking that rates are going to rise, just if the opportunity exists and it's there to take, why not, right? But I don't know, what goes through your head when you're making that calculation?
Well, it's always, we've talked about in past episodes, you want to pay taxes when you can do so at lower rates versus high rates. And the present value stuff it doesn't really enter into that too much. It's really more about, am I going to pay at a higher rate if I trigger the income today? Or would I pay at a higher rate if I wait into the future to trigger the income? And so, to the extent that you're worried tax rates may be higher in the future, this just leans you in the direction of maybe being a little more excited about the idea of doing a Roth conversion today to help better set yourself up for avoiding taxes in the future when you think rates might be higher. Not that that's a prediction that it will happen, but with deficits and debts where they are and everything else, most of the conversation around tax policy leans in the direction of taxes don't have any direction to go but up at some point in the future.
That's fair.
Okay. So that was point number 1. There's 3 points in total with this. Point number 2 is an important issue for couples, that when eventually there's only one surviving spouse in that couple, the year after the death of the first spouse, if you were married filing jointly, that survivor switches over to single filing. And there's real implications as a single filer where they, even with some of the reduction, Social Security benefits will decrease and so forth. RMDs don't change. RMDs are not based on a household. They're based on individuals. So they'll still have the same amount of RMDs, they may have less overall income coming in, but at the same time, federal tax brackets tend to drop in half, or, well, depending on where you are in the tax brackets, but they may drop in half. The Medicare surcharge levels tend to drop in about half for most of the thresholds. The Social Security tax torpedo doesn't drop in half, but overall, a single filer may end up with a higher tax bill than married filing jointly would have had, even with the loss of some of the Social Security benefits or other pensions and things that the survivor would, or that the person who passed away also had when they were alive. So you might have a higher tax bill as a single filer than married filing jointly, even after losing some of the income. That's a potential reason. Let's front load the taxes when we can do so married filing jointly, when we have more capacity to have ordinary income taxed still within lower rates versus a single filer. And our RMDs is a big part of that, because again, RMDs are going to be the same for, it doesn't matter how big the household is. It's based on the individual owner of the account.
Oh, I got you.
Okay. And then point number 3 about why you might want to consider front-loading taxes is IRAs have embedded income tax liabilities. And this becomes a conversation around if you're at the point where you think you're going to leave an inheritance, who should be paying the taxes, you or your beneficiaries? Now, if your beneficiary is going to be a charity, go ahead and they pay tax at a 0% rate if they're a tax deductible. I mean, if they're a charity that's qualified to not pay taxes. But thinking about adult children beneficiaries, in the past, they had a lifetime stretch, and the Secure Act that was passed at the end of 2019 eliminated the lifetime stretch for many types of beneficiaries, of which adult children are one of the key examples. They now have a 10-year window to deplete the IRA, inherited IRA, or Roth inherited IRA. They don't have to pay taxes on an inherited Roth. They just have to take the money out. The problem is if they inherit an IRA now, instead of having that lifetime stretch, they have to get those funds out within 10 years. And if they inherit those accounts when they're in their peak earnings years, say that your adult children are in their 50s, when they inherit the IRA from you, they may have to deplete that over a 10-year window where they have the highest incomes of their lifetime and maybe facing the highest tax rates of their lifetime. And so the question becomes, who could pay taxes at a lower rate? Could you, as a retiree, do the Roth conversion and pay tax at a lower rate than your beneficiaries might ultimately have to pay if they receive that account and then have a 10-year window to draw it down? And so that, to the extent that we switched with the Secure Act from the lifetime stretch to the 10-year window for many types of beneficiaries, that can lean towards the, when you're doing this sort of calculation, having the retiree do the Roth conversion and pay the tax today at a lower overall rate.
That's a great point about the taxes on the children. Simply because, let's just say, for argument's sake, the person passes away at 85. They had their first kids when they were in their early 30s. So, yeah, their children are in that window where they're maximizing their income around that time period.
In their
So
50s.
I'm just results vary, obviously, but it seems that you're right in terms of the children part. It's usually going to catch them as in their peak income year window.
Yeah, that's the concern. You get this inherited IRA in your peak earnings years, and you have 10 years to draw it down.
Yeah,
it may create some unpleasant tax situations.
all right.
Now, of course, that's going to vary case by case, and also to the extent someone doesn't know how long they're going to live. They don't know how old their kids will be when they inherit the account either. But, just as part of that planning, if you think you can pay the taxes at a lower rate than your children will have to, and you're pretty sure they're going to be inheriting it, it's much better for them to inherit a Roth an IRA than it is to inherit an IRA with that embedded income tax liability.
The other thing, I want to be more precise. I wasn't as precise with the first question for you to get your personal thoughts. You're talking about, in case tax rates go up, in case tax rates go down, this is something that you may want to consider. And directionally, you're kind of covering your angles, right? When you are to take a little bit of a separation from that topic, when you're doing planning and you're entering tax rates, future tax rates, and things like that, do you change up rates based on where you think tax rates are going to be, or do you just look at the current rates and you just plug that in, even though there's a dollop of optimism that they'll go down or a dollop of pessimism that they'll go up? You still stick to what the rates are, and it is what it is. You know what I mean? I'm trying to get you, how do you balance making planning decisions on where you think the rates are going to be versus how they're just set to be into the future right now if nothing ever changes?
Yeah, I stick to current law. So I use tax rates for 2024 and 2025. And then in 2026, I switch back to where current law says they will be without further congressional action. I think we talked in a past episode how Bob French disagreed with that approach. He just wanted to stick with the current rates, but he's changed his view on that. He now agrees with me. That's when we changed up the funded ratio.
I subscribe to that as well. I just want to make sure that that's different, though, than when you're saying capitalize on these deduction bunching and things like that. It's just certain assumptions you can say with a lot more certainty that go beyond government policy, which is when you retire, you're going to not make as much money. Hence, your income will be lower. So you should plan for having a lower tax rate into the future. You know what I mean? Like things like that. Even though those are projections, those are not the same type of projections trying to outguess where the government is going with their policy.
Right. There's no, with what I'm talking about, there's not, other than mentioning this idea that maybe tax rates will be higher in the future. That's not part of any sort of simulation or anything. The story around you might be paying taxes at a lower rate in the future is just really based on assuming current law, you have less income when you're retired, and therefore you think you'll pay less
Yeah.
taxes when you're
And I
retired.
think that's quite
But the pitfalls, we got to be careful about that, because with all the pitfalls we talked about on past episodes, even though your federal income tax bracket might be lower, the effective marginal tax rate you're paying may not be lower. So there's a caveat to that. But that's the general conventional wisdom. Retirees will pay less taxes because their incomes are less, assuming current tax rates are projected in the future. You
okay.
could do some sort of scenario testing where you, well,
No,
what if I
just wanted
increase
to,
all the tax rates?
I just wanted to make sure people understood that we're not making heroic assumptions here. We never do, not even with planning. The assumptions that we are making on potential changes are not based on Nancy Pelosi's proclivities or anything like that, or whoever the conservative analog is. Either way, it doesn't matter to me. These adjustments are based more on the assumptions that are centered around just life milestones that everyone goes through. That's all.
Right, right. And like I was mentioning too, though, if you read some of the financial planning content out there, the supporters of life insurance will put a lot of emphasis on the idea that tax rates will be higher in the future. So then they explain how life insurance can be treated kind of like a Roth, but with unlimited contributions. So they really want to emphasize pay the taxes now rather than in the future. All we're saying is, that may be a consideration for some people, and if anything, tax rates may be higher in the future, but we're not really saying, oh, this is going to absolutely be the case, so you better pay your taxes today. Just
Wait, you
pointing
did
out
an amazing. Have you acted before? Because you did a great job. Oh, I better do it now. That was like for people watching the video of this feed. Wow.
Yeah, doing the whole Macbeth.
Yeah. Wow. All right.
Out,
Go on. Wait. Do it again. Do it
was
again.
that, out, damn spot. Isn't that the Lady Macbeth
I
washing her
don't know.
hands?
Actually, I don't know. But
It's Throne of Blood from Kurosawa. That's his take on Macbeth.
well, I
It's been
think
a
a lot
while.
of those. Which is the one? The what's it called? Why am I blanking out? Never mind. I'll stop right now. Let's get to the taxes. I'll come back to it later.
Yeah. So those were 3 reasons why you might consider front-loading taxes for what they're worth and to the extent that they're relevant in your case. It's 3 other considerations. Tax rates might be higher in the future. Single filers, widows in this scenario, face a penalty compared to married filing jointly. So pay the taxes when you get that opportunity to get those benefits from married filing jointly versus forcing that surviving spouse to pay taxes at a higher rate when that time in life happens. And then with the Secure Act, if adult beneficiaries are going to be the beneficiaries of your IRAs, that 10-year window can be onerous compared to the old lifetime stretch opportunities that were out there.
Okay.
Okay, a few other topics. One is just the idea of tax loss harvesting, and that can be more of a accumulation-based idea as well as retirement. So maybe we can let you tell everyone about tax loss harvesting, Alex.
All right. Oh, Ron is the one I was thinking of, but that's not Macbeth. It's another King Lear.
Oh
The
yeah, I think
Kurosawa movies.
that one wasn't on Max. I haven't seen it yet. Wasn't that from the 80s?
Yeah,
It's
yeah,
like one of
yeah,
his more recent
yeah,
ones.
yeah, yeah, yeah.
Relatively.
Well, more recent than 80. Yeah,
Yeah, I
yeah.
still have to see that
I'm
one.
sure it's Ron. Yeah.
I saw the ones that were on Max.
Okay. Tax loss harvesting. Yeah, that's an interesting one. This plays a significant role in a lot of portfolio management characteristics here, and this goes on the play of where you can add value to a large extent. Just in theory, just take a step back. There's 2 types of investment approaches, right? There's active where you think there's some inefficiency in the market and you find some price anomaly that you think either the market is not pricing in unexpected growth of something that could be, what have you, Nvidia right now. The market does not really appreciating the full impact of AI. So it's even going to go higher. There's a mispricing. Or the other way around, flip around, Intel. That one, they're even talking about Nvidia buying Intel now. Can you believe that way? And go back 20 years ago, and that's where the market isn't valuing Intel. It's, I don't know what it's trading at. Let's just say it's trading at 50, but it should be trading at 80. So there's it's really worth $30 more. So I'm going to buy it. So there's active and passive. If you're active, if you think there's inefficiencies, then tax loss harvesting, the opportunity for tax loss harvesting, that's kind of a silver lining, because you'd rather not do that. That's where you take people. That's where a lot of folks will say, if you're tax loss harvesting, you got a problem, because you should be outperforming the markets at all times. You shouldn't have any losses. That's that halcyon kind of idea, right? And so when
That's a
you're an
pretty
active,
confident investor to do that.
say it
That's a
again.
pretty confident investor to expect they'll never have any kind of
Yeah,
a loss.
exactly. No, but that's kind of, you see that every once in a while on CNBC, like, why harvest losses? You should always have gains. If you're harvesting losses, that means you're a loser. That kind of thing. And to some extent, if you say you add value by having gains, then yeah, it's kind of besides that, how is the play, Mrs. Lincoln kind of comment. Now, if you're passive, that's fine, because what you're doing there is you're harvesting. Philosophically, you're just saying, I'm going to pick winners and losers. I'm going to get the aggregate of the market, right? And so it's more palatable in that manner. And frankly, it fits into that philosophy. Anyone can obviously harvest losses. I'm just pointing out that a lot of times active folks should poo-poo that, or folks that are thinking about having a manager that's outperforming the market. That's the last thing they think about, because it's like, well, I should have gains. The reality is everyone has losses, and look at the numbers, right? We don't need to talk about that right now. So what do you do when there's a loss? Well, harvesting losses, what you do effectively there is, let's take Intel. You bought it at 80 and it's 50, and you're like, okay, I'm going to sell it. And you have a $30 loss. Let's say it's a $30,000 aggregate loss in that. Now, you can sell it. Once you have the cash for that sale, you can take it and buy something else, right? You can't buy Intel within 30 days of that, because then it doesn't count as you've harvested a $30,000 loss. Now you take you take that money, you buy something else, and you have a portfolio. And I'll get to what you can do later. But in effect, at the end of the year, that $30,000 loss, you can apply 3,000 of it to short-term capital gains or income, right? A year. And now with that, well, the gains, you can do it, but the income specifically 3,000. What you benefit there is it's a higher offset, relative to the gains. Then you can offset the rest with short-term gains and short-term losses, on and on. If you don't have that, you can pretty much apply the 3,000 to income until your losses are all used up. It's happened quite a bit where we had prospects, we look at their taxes and they have losses and they haven't applied them to income for, let's say, 5+ years, because they were waiting on applying them to future gains, offsetting them with future gains. But if you wait that long, you're not capitalizing on the ability to save money at that moment, right? So it's a great little tool for offsetting. Now, what you're really doing is, because you're offsetting, what that means is you're not paying taxes when you recognize gains. But if you build these up and build these up, to me, what you're doing philosophically is at the end of the day, you're borrowing the tax liability from the government, right? And so you have to pay taxes. You don't do it. You have gains, right? But you keep on offsetting losses, and by keeping on offsetting gains with losses, is you're just delaying it. But over time, the portfolio will go up and up, and so eventually you will have to pay some sort of tax on it as the portfolio goes up and up, especially if you have passive portfolio and you're just tracking the market. The benefit of that is, by pushing that tax liability further and further down, you are effectively borrowing that tax liability from the government. And so your VIG effectively becomes the interest on what that tax liability is. That's theoretically where that extra bump in the return comes from. And what I mean by bump in the return, it's after taxes. So if you had if you had gains of $100,000, right, but you're able to offset $50,000 of that with losses that you've had along the way, but you're always invested in the market. Well, that's, the taxes on $50,000. Let's just say it's a 20% to make the math easy, right? Your capital gains would be 20%. It's 10 grand, right? And so you've effectively gotten, in effect, 10 grand by not having to pay taxes. That's the benefit of just harvesting losses along the way. So then you can systematically use them to offset gains. And what that benefit is ultimately is that liability on the taxes that you've pushed out and out and out. The first few years, it ends up being like roughly 30 to 40 bips, depending on the volatility that you've had. You want a lot of volatility because it helps, right? But it's about 30 to 40 basis points off of a percent. That gets lower and lower after about 5 years, like I said, unless you have new infusions of cash where you can buy new positions and so forth. Over time, markets go up. So after 5 years, you've kind of expended that. And so then what you have to watch out for is just the tracking error. And what I mean by that is, let's say you have a portfolio of the S&P 500, right? And instead of buying the S&P 500 stocks, you buy 200 stocks. And those stocks give you a good representation of the S&P 500 across all the industries. And let's say for the pharmaceutical industry, you chose, I don't know, Pfizer, J&J, Merck, Eli Lilly, Roche, and let's say Novartis. So you have 6 stocks, right? And that's going to represent the pharmaceutical industry, as part of that 200 stock representation of the S&P 500. And let's say those 200 stocks can track the S&P with a tracking error of 3%. That means that your returns will be within 3% of the return of the S&P 500, not percentage points, but 3%, right? And so that gives you more or less, you're getting that beta of 1 or 0.97 to 0.103, right? And you're good with that, right? That's the balance of not buying 500 stocks. You do it with 200 stocks, and it's more or less. And over time, that tracking error compresses. It's just in any given year, right? And so for the pharmaceutical industry, like I said, you had those 6 stocks, and let's say for the first quarter, and you have, for argument's sake, $50,000 in those companies to give you that representation. And let's say the first quarter happens, something happens with some sort of public policy, right? And the pharmaceutical industry just takes a hit. And so you have a 20% loss in the first quarter. And so you were buying, out of those 6 stocks, you had Pfizer, J&J, and Roche, right? That gave you a tracking error of 0.99 to the pharmaceutical industry. But you have that 20, they took the same hit as everyone else in the pharmaceutical industry. So you're able to capture $10,000 of losses because you sell one day to the next, Pfizer, J&J, and Roche. The moment you sell, you have that amount in losses. You turn around and buy Merck, Eli Lilly, and Novartis. So you now, a minute later, you have the same representation of the pharmaceutical industry. But so if it goes up the next minute, the next day, you're fine. You still have that same return. But you've captured the loss of Pfizer, J&J, and Roche, right? And so you have a $10,000 loss in your pocket that you can then apply later on. You can apply it to distributions that you take from a portfolio. You can apply it from, let's say, you're going to have a capital event in 3 to 4 years from a planning standpoint. I'm going to sell a building, whatever. You're going to have loss. You're going to have gains that you want to offset. You build up this bank. And so you can take it to the point where if you're going to have $100,000 gain in 4 years and you don't want to pay taxes on it, well, and you have, let's say, $1 million of an investable portfolio that's just tracking the S&P, and you do that with individual stocks, let's say 5 years, again, this is all hypothetical, you have $60,000 in losses. Well, you're only paying on $40,000 in long-term gains then, because you can offset the $100,000 gain with $60,000 in losses, and you're still tracking the index. It becomes very interesting in that manner, and that's one example, but you can do many, many more with that. Now, what you want to keep track of is tracking error, no pun intended, which is, at the end of the day, you don't want the tax tail to wag the dog, so you want to make sure that you're tracking and capturing the market. That's number one, right?
Yeah, because you can't have a substantially identical security.
Well, yeah, there's
30 days.
yeah, you can't buy the
either
same
direction.
Yeah. So there's tracking error you need to have. The other piece where it trips people up, you have to wait that 30 days. But some people don't
And
realize that
also
they have a
before.
401k, and in their 401k they have the S&P 500 or something, right? Let's say it's the Vanguard S&P 500. And then in their taxable account there's a loss and they sell the S&P. But they forgot that they have like automatic investment
Automatic.
in their 401k. So that doesn't
Uh-huh.
count then. It can't be the same security, can't be, or something that's almost as it can't be in different accounts either. If you own it, you're going to run into issues. And
Right. And so
so
if you automatically reinvest dividends or employer contributions in
yeah.
another
There's
account,
gotchas. Yeah. So what
you
you
can't
want is,
buy 30 days before or after
yeah,
the
I mean,
sale.
we can do this at scale ourselves because just software that's available to advisors is different than what you have yourself. But just FYI, you need to you have to keep that into consideration. And there's all these like direct indexing strategies now that there's a place for them, but you especially with tax loss harvesting, that you need to make sure that they're speaking nicely with your other accounts to make sure you're still on track with that. But
Mhm.
in my view, I see tax loss harvesting from an investment standpoint, something that adds real value, but it wanes over time, simply because stocks do go up over the long term. And again, this is if you have that passive philosophy. It's one of these things that after 5 years, if you don't have new vintages of cash coming in, tracking error becomes problematic. And that's kind of an untold secret that all these separately managed accounts won't tell you about. Like tracking error can be problematic 5+ years. If there's a financial planning need, I think this becomes actually something for serious consideration, because you get the investment piece, you get the tax planning piece to it that helps significantly, and then you get these kind of like little advantages along the way that we're talking about today that help out tremendously from that. I think, Wade, without getting too much more into it, did that provide, since I was the one doing the
Yeah.
talking, did that provide a nice sort of and now you know?
Yeah. Knowing's half the battle. But yeah. And then also just in retirement, if you're ultimately in a situation where you're not going to be ever spending all those taxable assets because you're probably somewhat overfunded for retirement, you do get that step up in basis at death as well. That
Yeah,
will erase those
yeah. If you
streams
can push
forever.
off taxes, because all you're doing, right,
Forever.
all you're doing is borrowing. So if you can push out the taxes and then flip it to the next one, you get stepped up. Oh my goodness! And this comes into play too, where, well, when you do the donations, doing the gift, but that's different than it's a huge benefit. It's just one of those that, from an investment standpoint, it does have a ceiling. It's not the gift that keeps on giving forever and ever and ever. It could be problematic to unwind if the tracking error becomes unwieldy. And that's one of these things that folks won't tell you this on day one. They'll tell you this on day 1,000. And then
Mhm.
it can be problematic. But for the purposes of what we're talking about today, it's something for serious consideration.
Great, great. Yeah. And so the next thing on the agenda here is deduction bunching. And this gets into the nonlinearity related to the itemizing versus the standard deduction. And especially in current law, and this is another fact could reset in 2026, but the standard deduction is pretty big right now. It can be hard to itemize these days. And the idea, just consider an example where maybe you'd like to donate $10,000 a year to charity. If you consistently donate $10,000 a year to charity, you may never get any tax benefit from that because every year it's less than the standard deduction. And with other below the line deductions as well, you never get over the standard deduction. Deduction bunching would say, let's make, in this simple example here, instead of $10,000 a year, in year one, let's donate $50,000. And then in years 2, 3, 4, and 5, we won't make a donation. By donating the $50,000 in year one, that will get you over the standard deduction so that you will be able to itemize and you'll get a tax benefit on the portion of that above the standard deduction that you would have never otherwise received any sort of tax benefit for. So deduction bunching is about grouping below the line deductions into one tax year. There's also at the margins potentially some room to play around with local, if it's allowed where you live, the state and local taxes where there's that now ceiling of $10,000. If you're below that, and you're able to say, pay your property taxes in December for the current year, and then also prepay for the next year, something along those lines. There may be more limited chances for that one, but paying 2 years worth of state or local taxes in 1 year could be another way to deduction bunch at the margins. The charitable contributions is probably the much bigger opportunity with regard to deduction bunching.
I agree. I think this is something that McLean used to be at we used to chair the investment committee for the Community Foundation of Northern Virginia, and this was one of these things that they would have us speak to potential folks that are thinking about donating, specifically, front loading the charity because they wanted to make it over that hurdle, that $12,000 hurdle. And yeah, if you can do that, it helps a great deal. I mean, even within our soccer association, Alexander Soccer Association, this is something that they're even promoting in their email things now. I talk about like getting sophisticated, right, and ambitious, I guess, at the same
Yeah,
time.
we're gonna get some big donations.
Yeah, well, what their angle was. Hey, your kid's most likely going to be here for, let's say they start at 6 through 16, right, for 10 years. So things like a mafia, you can't get out. 6 through, they're there for 10 years, and you're going to donate 2,000, let's say 1,000 a year, and some folks do that. It doesn't hurt to ask, right?
Mm-hmm. Yeah, and just a reminder about that. Below the line deductions do not impact your adjusted gross income, which is the important number for a lot of those pitfalls we talked about in past episodes: Social Security benefit, taxation, IRMA surcharges, and so forth. But then also, probably astute listeners are starting to scream out, why aren't they talking about donor advised funds? So let's mention that here as the practical way. If you're deduction bunching, if I'm going to make 5 years of charitable contributions in 1 year, I may not be ready to do that directly to one charity all at one time. That's where the donor advised fund comes into play. I can donate that money to my donor advised fund, get the full tax deduction this year, but then spread that out over time to multiple charities. And that can be the practical way to actually be able to do this in a manner that doesn't just mean making a huge contribution to one charity in one particular year.
That's when I was talking about I almost got ahead of the plot, so I held back. That's when I was talking about the Community Foundation of Northern Virginia. That's effectively a donor advised fund. But then I was going to get into the details of, you're right. A lot of folks want to, donor advised funds come into play too, because a lot of folks have, they've got a sizable chunk of money, and they talk about having their own charity. I've got $5 million. I want my own charity, which is understandable.
It's an easy way to have a family foundation type of thing without all the administrative headaches.
Exactly. That's exactly it. That's the selling point, and there are great opportunities around that. I even Fidelity and Schwab have their own, like for direct to consumers. I think they have a big donor advice fund. But
yeah, I did open one in 2017 when we still right before the standard deduction shot up to take advantage of a big charitable contribution in 2017.
Yeah. And so many communities have donor advised funds. I would check into those, because what the benefit of that is, all of these financial planning things. But let's say take the Alexander Soccer example. I don't want to donate like $40,000 to a soccer association, right? I don't mind a little bit. A donor advised fund can help with that, because you don't know where it's going just yet. You want to have this huge sort of impact, but you want to take your time with that. And, you want to do it this year, but you don't have time to give it the mental calories. And so donor advised funds are a great way to go about doing that in that manner. And then frankly, if there's new charities, you can simply try them out, see how organized they are, because it's one thing to find a cause that you support. It's another thing to execute the money to a cause that you support efficiently, right? And so sometimes it just takes a lot of trial and error, if you will, and you're going to be working with these folks for a while. So you want to make sure that you feel comfortable with them, aside from the planning issues that Wade is mentioning. But that being the case, they're great. I can't tell you how impactful those things have been just from talking to people. And Wade, we should you know what we'll do? We'll bring in Jessica to speak about this. You know how
Okay.
to combine it, because she's now on the board of the Parkinson's Foundation here in DC, and she deals with these issues, like the everyday issues, and I can't stress enough here. You know, this tends to be about numbers, but the personal satisfaction when you get this right, the planning part right, the, you know, if it's more money is better than less money, right? So the personal financial planning piece correct, and then the impact, you know, putting it in the right place and to be part of your legacy, it just it's truly amazing to see. And the beginning point, sometimes a family foundation doesn't make as much sense simply because of the administrative headache that folks don't know what they're getting into. You know, that sort of, you don't know what you don't know. And once you know, donor advised fund makes a lot of sense.
Hmm. Yeah, and it really can create something like a family foundation, but when we're talking about like tens of $1,000s instead of hundreds of thousands or millions of dollars, where it's just not practical to set up a formal foundation.
Yeah, but I would even say the barrier for a formal foundation is higher than I think people think.
And one other potential benefit of the donor advised fund is the ability to donate appreciated shares, which can be hard to do to individual charities. But then not only do you get that deduction, you're also eliminating the capital gains from the picture. So if I donate $30,000 in cash, well, I can apply that deduction to my taxes. But if I donate $30,000 of a stock that had a cost basis of $10,000, now that $20,000 capital gain, I'm never going to have to pay taxes on that capital gain. And if I also had cash I could have donated, instead of donating the cash, I donate the 30,000 in stock, and then I use that 30,000 cash to buy the same stock. This is not loss harvesting. This is like gains harvesting.
Yeah,
Uh,
yeah, no,
I now own the
absolutely.
stock with a reset cost basis at a higher level. So
Absolutely. Yeah, think about what he said. So you have 10,000 in cash and you have the stock. You can give the cash, right? But then you still have that liability on the capital gains on the stock. If you instead give the stock, you can just turn around that moment and buy the same stock, you know, buy the $10,000 worth of Nvidia. And what you've
yep.
done is you've not only donated $10,000 worth of something, you've removed that tax liability at the same time. And that charity, they're not going to pay taxes on it. They can turn around, include it in their portfolio, or just sell it just the same, and use the cash for the proceeds. Now, if you do it with smaller charities, they may not be equipped to deal with the stock transactions, this and that. Donor advised
Mhm.
funds, that's just par for the course. That's almost a table stakes for them from an admin standpoint.
Okay. So that really does it for today. It's again a couple of different strings of the conversation, but we wanted to cover that. The next few episodes, we will talk to some advisors from McLean about kind of practical implementation of this, and then we still want to have that deeper. We're part of the tax planning arc here. We're going to do that deeper dive into really digging into the Roth conversion story and the effective marginal tax rate management and how to think about uh, not just reducing lifetime taxes, but the important thing is increasing after tax spending power and legacy. So that's still coming ahead on Retire with Style.
All righty, Wade. Thanks, man, as always. And thank you all for listening. We do appreciate it, and more to come.
Catch you next time.